Hello. Welcome, students. This is Samuel Muchai, your Accounting Made Simple lecturer. Today, I want us to solve a CPA1 Financial Accounting 1, December 2021, question 2 question. Now, this question requires that we prepare the statement of profit or loss for the year ended 30th of June 2021, which takes 10 marks, and the statement of financial position as at 30th of June 2021, which earns you 10 marks, a total of 20 marks. We are told that Zambo Limited has an authorized capital of 2,000 ordinary shares of shillings 20 each. The company's trial balance as the 30th of June 2021 was as follows. Purchases and sales, admin expenses, bad debts written off, inventory, debenture interest paid. Every time you find debentures, and very rarely will you find a question related to debentures, the first thing you need to check is what was the debenture interest incurred compared with the debenture interest paid, to find out, did we pay all the debenture interest? So if you just look at that and you find we are told we paid debenture interest amounting to 140, and if you go down there, you will find debenture, 12% debenture of 2 million. You need to find out how much is the debenture interest expense. So if you want to say debenture interest expense, we're told that we have 12% debentures of 2 million. 12% debentures that attract interest of 12%, and they are the value is 2 million. 12% times 2 million, 0.12 times 2, 123, we get 240,000. So our debenture interest expense is 240,000. Our debenture interest expense is 240,000. But we are told we paid 140. So the debenture interest expense is 240, less paid. We paid 140. We paid 140,000, meaning 100,000 was not paid. Debenture interest payable. This is shown in the balance sheet. This is the current liability. It's a current liability of 100,000 and a debenture interest expense of 240. The expense is not what was paid. The expense is what was incurred. We incurred 240, but we only paid 140. So the expense is 240. We paid 140, and we have a balance to pay, which is a current liability of 100,000. So from debenture interest expense, we have investment income. Investment income tells you that we have investment as an asset. Then we have an investment of 1.8 million, salaries and wages, directors' emoluments, insurance, cash at bank, motor vehicle at cost, freehold land at cost, furniture and fittings at cost, accumulated depreciation, motor vehicle and furniture and fittings, general reserve, revenue reserve, and revenue reserve. Anytime you do a question, if there is general reserve and there is revenue reserve, it is telling you that revenue reserve is the same as retained earnings. The revenue reserves are the same as the retained earnings. Then 12% debentures, accounts receivable and accounts payable, ordinary share capital, allowance for doubtful debts. We are told, number one, the inventory as of 30th of June 2021 was valued at 1,240,000. You are given the closing stock. The freehold land was revalued to 9.4 million. If we were to get freehold land, if we get our freehold land, from the trial balance, we get a balance brought down. The opening balance of freehold land at the beginning of the year, from the trial balance, it is 6,400,000. It is 6,400,000, but you are told it was revalued, balance carried down, it was revalued to 9,400,000. 9,400,000. So the closing balance is 9,400,000. That therefore means we are revaluing it upward with, if we were to say shillings in thousands, it means we are revaluing it upward with 3,000, so that now we get here 9,400,000. So this goes to revaluation reserve. This goes to revaluation reserve. If we were to create our revaluation reserve account, we are saying we debit freehold land to increase it with 3,000 as we credit revaluation reserve with 3,000. As we credit revaluation reserve with 3,000, and we say it is from freehold land. It is from freehold land. It is from freehold land. Then we are told part of the revaluation, not everything, but part of the revaluation reserve amount was used for a rights issue of 1 for every 4 shares held. For every 4 shares held. So we look at our ordinary share capital is 28,000. Ordinary share capital, the value of ordinary share capital is 8,000. And each of them, if we divide by par value, that is, we are saying it is 20. It is shillings 20. Divide by 20, we will get a figure of 400,000 shares. 400,000 shares. So we have 400,000 shares. So, and we are told for every 4 shares, we are issuing a rights issue of 1 share. Number of shares issued. Shares issued is therefore the 400,000 shares you divide by 4. The 400,000 shares you divide by 4, and therefore number of shares issued. 400 divided by 4 is 100,000. 100,000 shares. 100,000 shares, and we are saying that they are being issued at shillings 20. They are being issued at shillings 20, so, and therefore the value of shares issued is 100,000 times 20, which is equal to 2 million. 100,000 times 20, which is equal to 2 million. So we are issuing shares. So if we go to ordinary share capital, we are saying that the balance brought down from the TB, the ordinary share capital is 8 million. The ordinary share capital is 8 million. It is 8 million, and we are issuing other 100,000 shares at a par value of 20. So, and we are issuing them from revaluation reserve. We are issuing them from revaluation reserve. So we debit revaluation reserve as we credit ordinary share capital with 2 million. So here we come and say ordinary share capital, 2 million, and here we say from revaluation account, we are getting 2 million. So our closing share capital will be 10 million. Our share capital balance carried down will be 10 million, and our revaluation reserve in the balance sheet will be 1 million. Our revaluation reserve in the balance sheet will be 1 million. Our revaluation in the balance sheet will be 1 million. Our revaluation reserve balance will be 1 million. Our revaluation reserve balance will be 1 million. We are told at the 30th of June 2021, insurance paid in advance amounted to 40 million shillings. So if we get the insurance account, and we say balance brought down from the trial balance, we have insurance of 160. And we are told we had paid although we paid 160, we have insurance in advance of 40, meaning there is something we never spent. So we say balance carried down. What we never spent, we carry down to the next period. What we never spent, we carry down to the next period. what we never spent to carry that. Although we paid 160, we had paid 160, but we had not spent 40. So the 40 becomes a current asset. Prepaid insurance becomes a current asset in the balance sheet, prepaid insurance, and the rest becomes insurance expense in the P&L account, 120. The rest becomes insurance expense in the income statement of 120. 40 becomes prepaid insurance. 40 becomes prepaid insurance. Then you have salaries and wages outstanding was 160. So we say salaries and wages account. The balance brought down on salaries and wages. The balance brought down on salaries and wages was 1640. And we are told that we have, this is what we paid. This is what we paid, but we have what we have not paid. It is outstanding, amounting to 60. So it's a payable. It becomes a payable. So salary is payable. That is salary is payable. So we have a liability called salaries payable. We have a liability called salaries payable, which has a credit from salaries and wages expenses account. Salaries and wages expenses account of 60. So this is a current liability. This is a current liability to be captured within the balance sheet. Number 4, we are told the directors propose a dividend of 10% of the issued. Please mark issued, and therefore the issued is not 8 million and the trial balance. The issued is not 8 million, which is showed in the trial balance. The issued is now 10 million. The issued share capital is 10 million. So proposed dividend is 10% of the issued share capital. So proposed dividend is 10% of the issued share capital, which is 10 million. And therefore this is 1 million. 10% of 10 million proposed dividend. The dividend to be paid becomes 1 million. 10% of 10 million. 10% of 10 million, mark not 8 million, but 10 million. So that is the dividend to be paid, 10%. The dividend to be paid is 10%. Then we are told, and a transfer of 420,000 to general reserve. Transfer of 420,000 to general reserve. If we were to say transfer to general reserve, so if you were to say general reserve is to receive, general reserve account is receiving something. The balance from the trial balance for general reserve, the balance from the trial balance of general reserve is 2,100,000. 2,100,000 from the trial balance. But we are told we are increasing it. We will transfer 420. We will transfer 420 from the income statement. From the income statement, P&L. So we get 2520. So the closing general reserve to be shown in the balance sheet will be 2520. But in the income statement, we will deduct the 420 and we take it to general reserve. We deduct it 420 and we take it to what? To general reserve. Now, something very, very important to note. Anytime we talk about something has been proposed, it means it has not been paid. And therefore, although it's an expense, like this dividend, although we deduct it, it is also a current liability. It is both an expense to be deducted in the income statement. Dividend to be paid is an expense to be deducted in the income statement, but it's also a current liability. It's also a current liability in the balance sheet. Many students will deduct it in the income statement, but they will not take it to the balance sheet as a current liability. But the fact that it is proposed, it means it is not paid. If you go to the trial balance, you will not find a payment of the dividends of 1 million, meaning it's a liability. It's a liability. It's something incurred but not paid. It's something incurred but not what? But not paid. The corporation tax for the year amounted to 540,000. Again, if you look at the trial balance, you will find there is no tax paid. There's no tax paid. And therefore, it means it's an expense which was incurred. We will deduct it in the income statement, but we will also record it as a current liability in the balance sheet. We record it as an expense by deducting it in the income statement, but we also record it as a current liability in the balance sheet. Then you're told depreciation was provided at the rate of 20% for motor vehicles. So if we were to say depreciation, we were to say motor vehicle, we are told it is 20%. 20% on cost. Anytime you are dealing with the depreciation, you must be careful because you could be on cost, it could be on cost, or it could be on reducing balance basis. So this one you're told it is on cost. So you look for motor vehicle cost, and the motor vehicle cost is 4,200. 20% times 4,200, and the figure 0.2 of 4,200 is 840. Then you are told the one for furniture is 10% on reducing balance. Furniture is 10% on reducing balance. Reducing balance, we always said, you get the original purchase cost minus accumulated depreciation at the beginning of the year, then you multiply by the depreciation rate. And therefore, furniture at cost is 2,600,000, 2,600,000 minus accumulated depreciation and the trial balance for furniture, which is 780. 780, you apply the 10%. So 2,600 minus 780, you get 1820 times 0.1, you get 182. You get 182. So the depreciation for furniture is 182. Depreciation for furniture is 182. Then number 7, you are told, allowance for doubtful debts is to be maintained at 5% of the accounts receivable. It is supposed the closing balance. You're being given how to arrive at the closing balance of accounts receivable, allowance for doubtful debts. So if we were to say, record it here, we say allowance for doubtful debts. Allowance for doubtful debts. And we say, we are told it is 5% of accounts receivable. It is 5% of accounts receivable. And our accounts receivable is 2,200. It is 2,200. 0.05 of 2,200 is 110. So our closing allowance for doubtful debts is 110. If you look at the trial balance, the last item there gives you the opening allowance for doubtful debts of 80. So if we were to prepare the allowance for doubtful debts account, balance brought down, we are told it is 80. The balance brought down is 80. Balance carried down, we are told is 110. So the total is 110 both sides. So we are told it is increasing from 80 to 110, and it is increasing by 30. It is increasing by 30. And we say that both the increase or decrease in allowance for doubtful debts, they are taken to the income statement. An increase in provision for doubtful debts is an expense. So you just go to the income statement. Please mark that in one question, you can have bad debts written off and increase in provision for doubtful debts as two expenses that are related to debtors. Two expenses related to debtors. The debt which we completely wrote off, we were not providing for them, it is called bad debt. So you could be having bad debts, which is an expense, and you have a provision for doubtful debts increase, which is still an expense. If it is reducing, it becomes an income to be captured among other incomes. It becomes an income to be captured among other incomes. And those are the workings. Those are the workings that you're supposed to do to get to to be able to prepare our financial statements. So if you were to say debenture, we want to say, put some details here. Debenture interest expense, it is 240. Balance carried down, liability, debenture interest payable is 100. It's 100. Freehold land, we know freehold land is 9,400. We know that revaluation reserve balance, we know it is 1,000. And this we don't need. So we can actually use this area to prepare our income statement and our statement of financial position. We can prepare our income statement and our statement of financial position. So we want to prepare our income statement. We just come here and we say ZAM Limited income statement. So we do the income statement. For ZAM Limited. And we know how to prepare the income statement. We start with sales, and our sales from the trial balance is 10,936 shillings in thousands. 10,936. And then we say less cost of goods sold. Less cost of goods sold. We know we don't have return inwards. And we say opening stock from the trial balance. We get the opening stock from the trial balance, which is given as 840. Opening stock as 840. We add purchases. From the trial balance is the 6560. 840 plus 6560, we get a figure of 7,400. 840 plus 6560, we get 7,400. We don't have carriage inwards, don't have return outwards. So this is cost of goods available for sale. These are the cost of goods available for sale. So we less closing stock, additional information number 1. We less closing stock. Additional information number 1 is 1240. We less 1240, which is the closing stock. 7,400 minus 1240, we get a figure of 6160. We get a figure of what? 6160. And that has become the cost of goods sold. So 6160 minus 10,936, we get a figure of 4776. And this is what we are calling gross profit. From the question, we are told very clearly that we had investment income of 400,000. So we add investment income. Investment income of 400,000. For 4776 plus 400, we get a figure 4776 plus 400. We get a figure of 5176. 5176 as the aggregate income. That is our aggregate income. So we say less expenses. We say less what?
Expenses.
We say less expenses. So we deduct the various expenses which we have incurred. And remember my argument, always start with the expenses which you deduct, you did adjustments. The ones which you are doing adjustments. And the first one was debenture interest of 240. Debenture interest, it is 240. It is an expense. There is nowhere, reserve is not an expense. So we have insurance expense of 120. Insurance, and you are calling it We were calling it, insurance. Insurance expense, 140. Then we have salaries and wages, 1700. Salaries and wages, 1700. Then we have general depreciation, motor vehicle, depreciation, and we have motor vehicle. We said it is 840. This one, depreciation, motor vehicle, we said it is 840. And we said furniture and fitting, 182. We said it is 182. Allowance for doubtful debts. Increase in allowance for doubtful debts of 30. Increase in allowance for doubtful debts. We said it is 30. Those are the expenses that we adjusted. Those are the ones that were requiring our adjustments. Then we got to a trial balance and we check. We check whether there are other expenses which we never adjusted anything. For instance, there were admin expenses of 320 for the trial balance. Administration expenses, 320. Then down the line, your bad debt written off, 86. Bad debts, 86. Then inventory, debenture, interest, investment, income, inventory, the directors' emoluments, 240. Directors' emoluments, 240. Directors' emoluments, the payments to directors. Remember, unlike partners and the owner of a sole proprietorship, directors, the payment to partners and sole proprietorship owner are treated as drawings, but the directors' emoluments in a company are treated as expenses. Motor vehicle, freehold funds and fitting, motor vehicle, I don't see any other expense, so we now add them up. 240, 140, 240 plus 140 plus 1700 plus 840 plus 182 plus 30 plus 320, 30 plus 320 plus 86 plus 240, giving us 3778. That is 778. Let me add them up again. 240 plus 140, 240 plus 140 plus 1700 plus 840 plus 182 plus 30 plus 320 plus 86 plus 240 something is now the insurance, like you can see, our insurance expense is 120, it's not 140. Our insurance expense is 120, it is not 140. Our insurance expense is not 140, it's 120. It's 120. So if we were now to add them up, you get 240 plus 120 plus 1700 plus 840, 1700 plus 840 plus 182 plus 30, 182 plus 30 plus 320 plus 86, 320 plus 86 plus 240. We get a figure of 3758. You get a figure of 3758. You get a figure of 3758. That becomes total expenses. So we subtract from 5176 minus 5176. We get gross profit of 1418, a profit for the year. Profit before tax of 1418. We get profit before tax. We get profit before tax of 1418, and we are told that our corporation tax is 540. Additional information number 5. Additional information number 5, less income tax expense. We call it income tax expense. We do not call it corporation tax. We call it income tax expense. We subtract 540. Less income tax expense of 540. Less income tax expense of 540. We get a figure 1418. 1418 minus 540. We get a figure of 878. We get a figure of 878 as profit after tax. As profit after what? Tax. After tax, we less transfer to general reserve. We less transfer to general reserve. We say that the transfer to general reserve, our general reserve is growing by what? Additional information number 4, a transfer of 420,000 to general reserve. So we subtract 420, we get the profit of the general reserve. Now 878 minus 20, 878 minus 420, we get a figure of 458. 458. Now, something very unique. We get a figure of 458, but we said our dividend is 1,000. Our dividend is 1,000. Our dividend is 1,000. This is where we now come to the concept of capital reserve and revenue reserve. We always say that capital reserve are reserves in the firm which can never be distributed to shareholders as dividends. And revenue reserves are reserves which can be distributed to shareholders as dividends. Now, our profit after general reserve is 458. We want to pay dividends amounting to 1 million. But we only have 458,000. And therefore, we add the retained earnings retained in the previous years. So we add the revenue reserve retained in the previous years. So we add revenue reserve brought down. Whatever was brought down at the beginning of the year, which is 1,500. From the trial balance, it is 1,500. We add 1,500 so that we have enough to pay dividends. So we get to 1,500. So 1,500 plus 458, we get a figure of 1958. We get a figure of 1958. 1958. If we say less dividends, minus, so we give you, the balance is 958. So retained earnings carried down, or revenue reserve. Revenue reserve carried down is 958. 958. Our revenue reserve is 958 to be carried down to the next accounting period. Our revenue reserve to be carried down to the next period is 958, and this is what we're going to show in the balance sheet as a revenue reserve. That's the way to prepare the income statement that is giving us 10 marks. That's the way to prepare the income statement that is giving us 10 marks. And because of space, the only thing you need in the balance sheet is this 958. We know that our closing revenue reserve balance carried down. Revenue reserve balance carried down is 958. It is 958. So we can delete this and we do the balance sheet. We can delete this and we prepare the ZAM Limited statement of financial position. And prepare the ZAM Limited Statement of financial position. ZAMU Limited statement of financial position. Very careful about the adjustments that we have made. So we have said ZAMU Limited statement of financial position. Asset 30th of June 2021. 30th of June 2021. And we start with the assets. Then we come to non-current assets. And then we say cost, provision for depreciation. And then you get to net book value. We get to net book value. And we start with what we were calling freehold land, because that's the most permanent. Remember the order, freehold land. And we say the closing balance for freehold land is 9,400. 9,400, and we are not depreciating freehold land, 9,400. Then we go to furniture and fittings. Remember, land and building, plant and machinery, furniture, fixtures and fittings, and motor vehicles. So we come to furniture and fittings. Furniture and fittings. From the trial balance, we bought furniture and fittings at cost of 2,600. 2,600. And we know that from the trial balance, the opening depreciation for furniture and fittings, accumulated depreciation at the beginning of the year is 780. 780. If you add the charge for the year, furniture and fittings of 182 plus 182, we get a figure of 962. We get a figure of 962. We get a figure of 962. We get a figure of 962 minus 2,600 minus 2,600. We get a net book value of 1638. We get a net book value of 1638. And then we go to motor vehicles. We go to motor vehicles. From the trial balance, the opening balance of motor vehicles at cost is 4,200. 4,200. The opening balance of the accumulated depreciation for motor vehicles is 1,600. 1,600. If we add the charge for the year, we add the charge for the year for motor vehicles, 840. We add 840, we will get 2424. We will get 2424. We get 2440. We get 2440. We get 2440. We get 2440. 2440. So minus 4,200. Minus 4,200. We get a figure of 1760. We get a figure of 1760. So we add the three. We also have an investment. We have an investment. Additional, not even the additional information. We have investments from the trial balance of 1,800,800. Investment. We have investments of 1,800,000 within the trial balance. 1,800,000 within the trial balance. If you add the items, 9,400 plus 1638 plus 1760 plus 1,800, we get a figure of 14,598. 14,598. That becomes total non-current assets. Total non-current assets. Total non-current assets. Total non-current assets. Then we come to current assets. We come to current assets. And for the current assets, always, the first current asset always is inventory. The first current asset always is inventory. And from additional information number 1 is 1240. Additional information number 1, it is 1240. From there, we come to accounts receivable. Accounts receivable. And we said we have a provision for doubtful debts. Our account receivable from the trial balance is 2,200 less provision for doubtful debts. Less provision. Less provision. And we said our provision, our closing provision is 110. Our closing provision is 110. 2,200 minus 110, we get 2090. We get 2090. We get 2090. We get 2090. We say that we have prepaid insurance amounting to 40. We have prepaid insurance. We have prepaid insurance. From additional information number 3, we have prepaid insurance amounting to 40. Amounting to 40. Amounting to 40. This 40. This 40. This 40. Then we check on the bank. We check on the bank. Cash at the bank. Cash at the bank is 850. Cash at the bank is 850. We don't seem to have actual cash in the office. We don't seem to have actual cash in the office. We don't seem to have actual cash in the office. So if we add the 4, we get inventory 1240 plus 2090 plus 40 plus 850. We get a figure of 4220. Get a figure of 4220 as the total current assets. Total current assets. Total current what? Assets. Then we say total assets. We add total current assets to total non-current assets to get total assets. So we add 14,598 plus 14,598. We get a figure of 18,818. We get a figure of 18,818. We get a figure of 18,818. Those are the assets. Those are the assets. And then we say financed by. We say financed by. How do we get the money to buy, to have these assets? We say equity and liabilities. Equity and liabilities. And from equity and liabilities, we say equity and reserves. We say equity and reserves. We say equity and reserves. Or equity and reserves. From equity and reserves, we say ordinary share capital is 10 million. We have said our ordinary share capital, the balance now is 10 million. Ordinary share capital. Ordinary share capital. We said it is 10 million. Now, from ordinary share capital, we have general reserve. And we have said that our general reserve is getting to what? Our general reserve is getting to 2520. We say general reserve, which is closing at 2520. And then we say revenue reserve, which is this reserve for 958. 958, general reserve, revenue reserve, 958. Then we also had a revaluation reserve, which we said revaluation reserve of 1,000. Revaluation reserve of 1,000. Revaluation reserve of 1,000. If you add all of them, you get 11,123 plus 2520 plus 958. We get a total shareholders funds 14,478. 14 what?
478.
478. And you are saying that these are shareholders funds. Shareholders funds. Then we talk about non-current liabilities. Non-current liabilities. Non-current liabilities. And it is only the 12% debenture. 12% debenture. We say it is amounting to 2 million. It amounts to 2 million. From there, we can now delete this, but we keep this. The total assets must be equal to total equity and liabilities. Total assets, that is 18,818, must always be equal to total equity and liabilities. So to create more space, we must delete something here. And we say current liabilities, current liabilities, current liabilities. Current what?
Liabilities.
Current liabilities. Always current liabilities. Remember our format. Start with bank overdraft, then we come to trade creditors. You don't have bank overdraft, so we come to trade creditors or accounts payables, which is 640. 640. Trade creditors about 640. Then we find out other liabilities. We have said very clearly that we have salaries and wages of 60. Salaries and wages payable. Additional information. Salaries and wages payable. It is 60. Yes. We also have dividends payable of 1 million. Dividends payable of 1 million. We also have tax payable 540. Tax payable 540. Yes, I think those appear to be, but we also talked about debenture interest payable. Debenture interest payable of 100,000. Debenture interest payable, we said it's 100,000. So we add them, we get a figure of 640 plus 1060 plus 640. Get a total of 2340. Total current liability amounting to 23 what? 40. Total current liabilities. So we add the shareholders' funds, non-current liabilities, current liabilities to get total equity and liabilities. Total equity and liabilities. Total equity and liabilities. And 14,478, that is the shareholders' funds. 14,478 plus 14,478 plus 2,000, 123 plus 2340. 2340, that is 18,818. 18,818. The total equity and liabilities, the funding, is equal to the value of the assets. The balance sheet is balancing. The balance sheet is balancing, and when that happens, we are saying most probably, more likely than not, we have succeeded. We are correct. We are correct. Once again, I want to urge you, subscribe to our channel and hit the notification bell so that every time we load a new video, we are able to notify you. Thank you very much for your support.